I mentioned it before that one of the biggest investment mistakes that I made right out of college was not investing in certain tax-advantaged accounts. Those are costly mistakes that nobody wants to make. And that's why today's video is going to cover the top ways to invest tax-free. And this can include ways to invest with compounding growth being tax-free, or assets that have no state taxes, or investments that don't have any state or federal taxes. There are only a few options that are 100% tax-free, but I want to cover all three of these options today. It doesn't matter if you're new to investing or if you've been investing for years. Today's video should cover one or several ways to reduce your taxes from your investments. And as a teaser, I can state that I'm going to cover an investment option that I've had a ton of people request in other videos. And with there being so many topics to cover, I can't discuss them all, and I can't touch on every single detail. But if you want me to make another video where I go deeper into a specific topic, then just leave a comment below. I'll get started by discussing real estate, where there's several different ways to approach this. The first and most common option is the live-in flip option, where you buy a property that you live in for a minimum of 2 years, and when you sell it, you may qualify for capital gains exclusion. The exclusion is up to $250,000 in profit from the sale for an individual and up to $500,000 for a married couple filing jointly. My family and I have benefited from this in a big way because we sold our house in Washington State, where we did quite well, which is one of the few states with no capital gains tax. Sadly, it is a small list of states with no capital gains tax. I have a link in the description below that lists all the states and their capital gains tax. But let's say you take a different angle and you buy a rental property, but after a few years you decide that you want to sell it and you want to buy 2 more rentals from the profit. Since you didn't live in the property, of course you'd have to pay capital gains at the federal level and probably at the state level too. And the amount in tax is based on your income. If you're married filing jointly and your annual income, I don't know, let's say it's $150,000, then you'd have a 15% capital gains tax at the federal level. But there's a way to defer those taxes by leveraging a 1031 exchange. This allows you to defer your federal tax and most likely your state tax as well, by taking the profit from the sale of one property and then reinvesting it into another investment property. This happens to be a great way to supersize your investment properties without having to take a hit in taxes. Now, there is another way to have investment property that's tax deferred, and also an option to be completely tax-free, and that is to invest in property with a self-directed IRA. This route can also be completely tax-free if you utilize a self-directed Roth IRA to make that investment. But if you use a regular self-directed IRA, then you're going to defer the taxes until you withdraw the funds from that IRA. But there will be capital gains. It's going to be taxed like ordinary income, just as you'd expect from an IRA. In a nutshell, a self-directed IRA is one where you've rolled over your existing 401k or your Roth IRA and created an LLC entity to manage the IRA as a self-directed retirement account. I personally have a self-directed IRA, and the process to convert my 401k to be a self-directed, well, it wasn't an easy process by any means, but it does give me the flexibility to invest in physical assets like real estate and other physical items that are outside of the stock market. If you'd like me to do a video just on self-directed IRAs, then once again, let me know in the comments. Now I'm going to shift over and speak to US Treasuries and bonds. In all cases, these are securities that are sold by the US government where they're going to be tax-free at the state and the local level, but they do still have federal taxes, for the most part. I need to explain the different types, and then I can speak to how you can manage to not pay federal tax on some of them. Today, items like the T-bills and the Treasury notes are a hot topic because the latest 4-week T-bill had a median rate of 5.5%, where they have no state or local tax. And as a reminder, a person can buy Treasuries from the government site called Treasury Direct, and T-bills, notes, and bonds can also be purchased from a brokerage site like Schwab or Fidelity. I walk through the details of buying Treasuries in some of my other videos, where I'll make certain to have a link below so that you can find one. With regards to the EE savings bonds, like the ones that your grandparents used to give you as a kid, well, they only earn 2.5% APY today. Those, along with I-bonds, have an option to be tax-free at the state and the federal level. And as a reminder, I-bonds are only available on the Treasury Direct website, where the rate changes every 6 months to account for inflation. The I-bond rate today is at 4.3%, and as inflation goes up or down, so will the rate on the I-bond. And as a quick reminder, if you withdraw an I-bond before 5 years, then you're going to be forfeiting 3 months worth of interest. And you absolutely can't cash it in your first year of owning it. So how exactly are they tax-free at the federal and the state level? Well, if you have children and you plan on them going to college, if you use the I-bonds or the savings bonds to pay for qualified school expenses, then they could be 100% tax-free. But there happens to be just a few requirements in order to qualify. The person paying for the college expenses had to have received these bonds after the age of 24. That's why this is mostly applying to only parents, not the students. On top of all of that, you must have a modified adjusted annual income of less than $100,800 if you're single and less than $158,650 if you're married. So if you're anything like me, where my grandparents gave me a $50 savings bonds for every birthday as a kid, I'm going to wait to cash them in, and then I'm going to put them towards my own kids' college expenses. Before moving on, I have a favor to ask of you. If you like my content, I'd greatly appreciate if you consider pressing the like button so my content here on YouTube can grow. And better yet, I'd love it if you'd consider subscribing so you can be up to date with all of my latest content. The next item to discuss is a Master Limited Partnership, or MLP, which is a hybrid company between a partnership and a publicly traded company, where they're going to be seen as a pass-through company. MLPs issue units, not shares, and a person buys units in an MLP as a limited partner in that business. In general, MLPs exist in businesses that are tied to natural resources like the oil and gas industry. They pay out distributions that are between 4 and 12% that are tax-free, which makes them very different from dividends. Taxes are due when you sell the MLP based on your tax basis. The reason they operate like this is because the distributions are based on a return of capital, and they are deducted from your cost basis. MLPs are complicated from a tax perspective, so make certain that you speak to an advisor before you make those types of investments. I'm going to provide a simple example for illustration. If you buy a unit of MLP on the stock exchange for $100 and then they pay out $10, the $10 isn't taxed, but the cost basis is now $90. And if you sold your unit today where the MLP is trading at $105, you'd pay a capital gains on the $15 because your cost basis has dropped down to $90 a unit. But if you don't sell your MLP units, then you can receive distributions near tax-free. Like I said, it's more complicated than my example, and it is possible for the cost basis to go all the way down to zero. And if that happens, then you would pay capital gains on the distributions after that. But here's where the MLP gets very interesting. If you pass away, then your heir is going to receive the units of MLP at the cost basis that the MLP is trading at the day that you pass. Even if your MLP had a cost basis of $1 and the unit now trades for $1,000 on the day that you pass away, your heir gets a clean slate start with a new cost basis at $1,000. If you choose to hold on to MLPs and not sell, they can be a great tax haven for you and your heirs. And because of the tax complexity, it is not suggested to have an MLP in your IRA or a tax-advantaged account because it's just going to cost you more money in taxes from those types of accounts. Here's a list of a few MLPs and their distributions that are being offered today. Since I covered MLPs and their tax-free distributions, I need to also touch on dividend stock. If you buy a handful of dividend stock that fall into the category of qualified dividends and you plan to hold them for the long term with the intent of capturing the dividends over time, then the qualified dividends are taxed as long-term capital gains. And on this chart, you can see the capital gains rates for the last year, where you have the potential to pay no federal taxes if your taxable income is below the 0% threshold. But I'm guessing most of you will fall in the 15% rate, which is still going to save you between 4 and 5% versus your regular income tax. The big difference making an impact is the state capital gains tax that I'd mentioned earlier, where some states have no capital gains tax, but then of course there's going to be California that could be upwards of 8%, which is absolutely ludicrous to me. I'll briefly speak to the 401ks and Roth IRAs because they clearly fit into this topic, but I believe that most people out there understand the tax opportunity with these types of accounts. So feel free to skip ahead if this part is a little bit too basic for you. I'll start with the employer-offered 401k, which allows you to invest money that is not taxed, and it is deducted directly out of your paycheck, which then drops your taxable income in the year that you make the contribution. But thankfully, the max contributions went up roughly 10% over last year. As a simplified and completely fictitious example, if you make $100,000 a year and you contribute $20,000 into your 401k, then it drops your taxable income from $100,000 to $80,000. If you have an average tax rate of 20%, that saves you $4,000 in taxes. Plus, whatever your employer contributes to the 401k is completely free money, so take full advantage of that. And to take the example a little bit further, that $20,000 invested in the S&P 500 over 20 years with an average return of 8% would be worth over $93,000 that grew completely tax-free. After hitting the age of 59 and a half, you can withdraw the funds from your 401k and it's going to be taxed as regular income. And if you live in any of these states, they have no income tax. But there are a handful of states that claim to not tax retirement income, and it may vary a little bit slightly by state, but here's the list that I was able to find. Now I'll move on to the Roth IRA, which is sort of the opposite of the 401k in that it's money that you've earned and has been taxed before you invest it into the Roth. And contributions do not reduce your taxable income. The max contribution in 2023 is $6,500 per individual, and there's an additional $1,000 catch-up added to the limit if you're over the age of 50. Once money is in the Roth, it can grow tax-free, and anything that you withdraw over the age of 59 and a half is also tax-free. The catch is that not everyone qualifies for the Roth IRA. Your modified adjusted gross income must be below $153,000 as an individual and $228,000 for a married couple that are filing jointly in order to qualify. The next area to touch on is health savings accounts, which happens to be a big mistake for me because I didn't invest in one right out of college. So long as you're in a high deductible health plan, then you qualify for having a health savings account where you can contribute up to $3,650 per individual per year. And in many cases, employers will also contribute free money to your HSA. Don't ever pass up free money. The funds in an HSA can be invested in things like stock, treasuries, and CDs. I go over the fine details of an HSA in this video right over here if you want all that nitty-gritty info. In essence, you can contribute to your HSA with pre-tax dollars, and the contribution reduces your taxable income just like a 401k. All the money that's in the account grows tax-free, and if you withdraw the money from the HSA and put it towards qualified medical expenses, the funds are not taxed at all. Let me repeat that. Not a single dollar is taxed. And the estimated medical coverage for a person during their entire years in retirement is expected to exceed $200,000. But here's the juicy part about an HSA. After age 65, you can take out HSA distributions with no fees and use for everyday expenses, not just medical expenses. But if you use the funds outside of medical expenses, they are subject to income tax. And if you happen to have money in your HSA when you do pass away, you can pass it on to your heirs tax-free to have as their own HSA. There's several other areas that I could be covering, but I'm going to finish off the video with municipal bonds or munis. These bonds are securities that are offered from state and local governments that are going to be funding projects like bridges, schools, and highway construction. You are essentially loaning your money to these state and local governments where they're going to pay you back interest and the principal at maturity. The thing about municipal bonds is that they have no federal tax, and if you happen to purchase them specific to your state, then they typically don't have any state or local tax either. These types of investments are very attractive for high earners because of the tax-free returns. The default risk for municipal bonds is exceptionally low, but it's not without risk. A person can buy a municipal bond on an exchange like Fidelity, and in some cases you can buy them from a bank. And I'll warn you now that most munis are callable, meaning that the issuer can call back the bond if the rates fall, pay you back your principal and any interest that they owe you, and then close the bond altogether. They can then reissue the bond at a new lower rate. That's the key risk with municipal bonds. But as a pleasant upside, they are available anywhere from 4 to 7% today. And they change daily on the brokered sites, so it does pay to look often. And similar to CDs, a person can also buy and sell municipal bonds on the secondary market. This way, your cash is not going to be locked in the investment. I promise that I'm going to make a separate video on municipal bonds, but I'll quickly show you what it looks like on Fidelity to give you a broad view of what it looks like. When I'm looking up munis, I find one from my state, and then I look at the call protection, the expected yield, the expected price, the rating, and then the coupon percent. The coupon percent is the interest payment that they will be making to you as an annual percent. And in this case, this top muni has a coupon of 4%, and that's what they would be paying me annually. But you may notice that the expected yield is higher at just over 4%. It's higher because the expected price is lower than the par of $100. That means that it is being sold at a slight discount, which adds more to the overall yield. Let's look at another one further down where the coupon is at 4%, but the expected price is at 101.712, which means you are paying a premium, or you're paying a little bit more than the par of $100. Just think of par as the baseline, and because you are paying more, the expected yield then drops to only 3.75%. This gets a little bit more complicated on the secondary market because people are going to be offloading their bonds early, so they're going to need to have different coupons and prices. Now let's assume that I'm from Colorado and I look on the secondary market for some munis. Here's one with a coupon rate of 4%. So that's what it will be paying me in interest annually. And this one comes with a large discounted price below par, and it results in having a yield to maturity at 4.791%. If you look at the bond on the next screen, you're going to see that it pays semi-annually, and it's not call protected. And looking further down, I see it is not federally taxable or subject to alternative minimum tax, just items I always want to verify. And if I'm ready to buy, on the next screen you can see that the minimum to buy is listed at 10, where each bond is equal to $1,000, so this would have a minimum investment for me at $10,000. This was a very high-level view of munis to give you an idea of what they look like and the process for buying them. It can be a little bit scary if you're not familiar with the language or the process, but if you happen to have substantial amounts of money that you want to invest tax-free, municipal bonds are a fantastic option. If you want me to do a video that goes in depth on municipal bonds, then just let me know in the comments below. That concludes my video on some of the top methods for investing with no state tax, or in some cases, no taxes at all. I hope you got some value out of the video, and thanks for watching.